Okay, we'll go ahead and get started. So thanks everyone so much for joining. So the topic of today's discussion is, about stocks and investing, how to get big money back in your portfolio. And, I'm really happy that portfolio manager Sundip Nag has been able to join us. So just quick introductions. My name is Shiv. I work in tech consulting in one of the big four consulting firms, and I partner with Sandeep, and and Sandeep's background is he's a fund manager. He's been a fund manager on Wall Street for the last 10 years, and he's managed more than $1 billion. So I'll pass it off to him to do the introduction, and then we'll get into a bunch of questions. And then after you finish the structured questions, we'll open it up for Q&A where you can ask questions. You can ask even the specific stock you're interested in or things like that, and we can get more into the discussion. So passing out to you, Sandeep, for an introduction.
Sure. So yeah, I've been on.
You're on mute, Sandeep.
Am I? Can you hear me? Can you hear me, Shiv?
Can you guys hear Sandeep, or just me?
Yeah, we can hear Sandeep. No problem.
Okay,
maybe
cool.
It's just me. Sorry.
Okay, cool.
All right. Go ahead, Sandeep.
Yeah. So I've been in the industry for more than 13 years now. Started my career at ING Investment Management in New York, then moved to Washington to work for Ashmore. So yeah, I've been almost 13, 14 years in the industry, managing about a $1.3 billion portfolio at ING and about 3.5 in Ashmore. Yeah, so that's a quick background of who I am. Shiv, now we can't hear you.
Yeah, I was testing my mute button. Okay. So let's start with the most important question in everyone's mind. Where is the market going for the rest of the year? Where is the market now? It's been like a good 2 years, but is it going to tank further? Is it going to rally further? What's the health of the market right now?
So the short answer to that is that the market is going higher in the US and globally. And there are two key reasons for that. Okay, so the first reason is that, let me start with saying that this Federal Reserve is brilliant. They've done a phenomenal job of actually laying the path forward. It's most industry fund managers today understand that what's happening is that for the next 7 meetings or for the next 4 meetings or for the rest of the year, you're going to see 7 interest rate hikes of 25 basis points. This is great because in the last, 50, 60 years, the biggest challenge that industry professionals, fund managers have faced is that there is no predictability to how quickly the rates will rise. But when you draw out a clear map of how you're going to do it, that just makes things very easy, because if you're a corporate, you can manage your balance sheet. If you're a bank, you can manage your exposures. If you're a nation, you can manage your currency and your central bank, right? So the Federal Reserve laying out a very clear path of how they're going to go forward with interest rates is phenomenal. Okay, that's point number one. That makes life very easy for everybody.
Okay.
Point number two is that, in my opinion, inflation is not a very big problem today. Okay, even though the media will keep harping on it, inflation is a problem when you have a massive recession or you have a slowdown or you're not seeing wage inflation, go up in the same order. What's happening in the US across multiple industries that we've been speaking to is that wage inflation is actually quite high. So in other words, people have a lot of money in their hand. Anyone who made, let's say, $100,000 in year 2020 is probably making $115,000 this year. And probably, maybe 10-15% more in the following year, right? So inflation, for that reason, I don't think is a significant problem. Point number three is that, again, the Russia-Ukraine war, while impacts energy prices, material prices, commodity prices, it's fair to say it's very well understood. And the worst is behind us, So I think, given where value is, for example, multiple tech companies are down 45-50% still. A lot of my industry friends have bought Netflix last month. They're still sitting on it, waiting for it to rally. But, there are a whole host of good businesses that are trading at very attractive valuations, very good prices. And for me, the 2 or 3 key reasons why the market was down, those are getting less worse. So it's going to be a decent year, I think. It's going to be a tough year, Shiv. It's going to be a challenging year because, the news flow will make it volatile. The commodity prices will make it volatile. But I think from a pure upside perspective, I think there's money to be made this year. Shiv, we can't hear you. You're on mute.
Sorry. So I think what in general I hear you say is that the market is going in a positive direction. So before we jump into if it's going in a positive direction and what we should buy right now, like the title of today's call is if I'm down in my portfolio, so I'm 30% down or whatever percentage I'm down, do I continue to hold on to my stocks and hope they bounce back because it's positive, or what do I do with my current stocks which are down?
If you are down 25-30% today, what you need to do is firstly ask yourself, where is the market headed? I've just answered that. I think the market is headed in a positive direction, right? So once you have that out of the equation, the next thing you need to ask yourself is, what do I own? And you split that in two buckets. Okay. If you own good businesses that are in the right themes going forward, a good business in the wrong theme, can create a massive challenge. As we've seen, good quality businesses like NVDA, like Salesforce, like so many businesses are down 40-50%, right? So if you're in the right theme, you own a good business, you can ride that, right? Because you believe the market will go higher. If it was going lower, obviously you would sell. But if you own, and I think this is the main reason why people lose money in the markets, if you have speculated into dogs, they will not rally. Okay. In the industry, we call them tennis balls versus an egg. You drop both on the floor, the egg will stay there, the tennis ball will bounce back. So if you have a stock that was just the internet fad, there was a lot of mentioning of it in blogs, and Jim Cramer spoke about it, and a lot of people were tweeting about it. And if you own one of those stocks, a great example is Beyond Meat. For years I've had institutional brokers call me on the stock, when it was just getting into an IPO mode, and when it was up very quickly to 180, 200 bucks, whatever. But if you own businesses like that, you need to cut your losses. You need to reassess, and you need to think, today, if I were to allocate money, which theme would I like to own? What is attractive? Where is my risk reward attractive, right? And you need to reallocate that into themes that will work. So I think that is the most important thing. I think the main reason why people sometimes don't do well in the markets is because A, they speculate, B, then they hold on to those dogs that they hope and pray one day will bounce back, and that seldom happens if you own a bad business. So my advice is, cut your losses. If you're down 30% on some of the bad names, hold on to that capital. It's looking pretty good, the market, and you slowly incrementally get into businesses that make sense and are in the right team.
Okay. So I think, you make a good point that, maybe I should cut my losses and, focus on more investable themes. But, how do I separate, my logical thinking from my emotions? For example, Beyond Meat, I may have bought it at the peak when it was, about 100. And, my friend said, oh, everybody's having the Impossible Burger on the menu, or, this whole, fake meat thing is taking off, and, you don't even get a veggie burger in Burger King anymore. So so and then, I keep thinking, oh, maybe it'll come back. It'll go back to about 100. We'll go up to 300, whatever. How do I stop cheerleading and versus just make a cold call and cut my losses? How do you emotionally make all these decisions, when it comes to balancing your portfolio?
You need to completely detach yourself from the outcome of investment or a trade. If at any point you believe you've made an investment, and this happens to the best of us, if at any point you believe you made a move that is wrong or is not panning out, or was just, you have new facts that now make you believe that this was a mistake, You need to then just detach yourself from the outcome and, deploy that money back into something that you believe will work. For example, if you're Steph Curry, trying to shoot 3-pointers, you're going to shoot 30 or 40, you're going to have 30 or 40 attempts, you're going to probably score 30-40% of those. You can't think about, the one shot that didn't go, because that's going to impact all your next moves, right? Easier said than done, I understand that, but you need to approach it. I think in any sport, and I think stock market in itself is almost like a sport or a game, right? You need to approach it where you detach yourself from the outcome. You stick to the process. That's the way I do it. There are times when we make mistakes, and it happens all the time, to be honest. And we obviously have a clear self-discipline where we will not, take a loss on anything beyond 8%. But it's simply following a matter of process. Emotions are the biggest problem in our industry. In investing, the biggest problem is emotions. Your intuitions are set to deceive you. You need to rely a lot more on a process, automate it, detach yourself from the outcome, and follow through. That's the way to do it.
No, it makes a lot of sense to me, but when my money is in the market, like, emotions are high, like sometimes, it's like, how do I know, like, like the dog, or if you call it, or like, how do I know if I'm like, holding on to something like, beyond meat, which is, maybe not the best stock versus, something which is more investable and, has a turnaround story, which is what you're talking about. Like some of the reasons might change and then the stock might rally. So like, what is your investment philosophy? Like, what's your secret recipe, if you will, to like identify some of these investable stocks versus, cutting your losses on the, some of the dogs?
Okay, so let me give you an example of what we recently did. So we are up 21% for the year already, and honestly, it boils down to 2 stocks. So let me give you one of the examples, and then I'll take you through my philosophy after that. So when the Russia-Ukraine war happened, right, when that news broke out, right, obviously we were all prepping for it. We knew about it. We were thinking about it. We were worrying about it. But when it actually happened, what we realized was that Russia is a major fertilizer supplier to the world. Not only to its neighboring countries, not only to China, but to a significant amount of that goes to the West and to literally, to Latin America, to Asia, all over, right? And so we realized, as sanctions kick in, as these supply chains get blocked, there's going to be a massive demand for fertilizer, and supply won't just match. So what did we do? We went and bought NTR, Nutrien, one of the largest suppliers of fertilizer in the world. And we did really well on that trade. So honestly, it's an investment for me. I'm holding on to it. It was 18% bet that ballooned and has become much bigger part of my portfolio now, which is a good problem to have. But it's that is the way we invest. We like to buy monopolies, duopolies, companies which have a very high market share, or which have a or which have a very dominating position in their sector, a dominant champion of its sector. We like to buy companies like that, or companies that aspire to be that and are very close to getting there. A small cap that perhaps can eventually become the champion of its sector, in our opinion. We buy them when there's a crisis. We buy them when there's disappointment. We buy them when there's blood on the street. We buy them when they're down at least 30%. And one of my mentors had very early in my career, taught me that you need to buy good businesses at the right price, and that's what I just stated, right? But that is not enough. You will very often buy a good business at a right price, and then it'll be 30% lower from where you bought it, and you'll be like, "What the hell do I do?" So that's only half the equation, right? So good business, monopoly, duopoly, whatever, at the right price, when it's down 30%, so there's a crisis. We are crisis investors, so when something has gone wrong. Then there are 2 additional factors that are very important for us. I'm talking about how we approach it. Then what matters to us is, what are the 1 or 2 key reasons why the stock is down, right? And are those 2 reasons getting less worse? Not coming back to positive, not coming back to normal, just less worse, right? And when that happens, that is when we, start to get excited about the stock. And then we're waiting for one last final thing, and that is a catalyst. And for us, the catalyst always is a turnaround in institutional volume. So, we spend a lot of time understanding who is. So, what happens towards the fag end as the stock is selling off and it's consolidating, you will always see a massive contraction in volume. Because what happens is there aren't enough buyers because people are scared, and the sellers are kind of done with selling their positions. So what happens is there's a complete contraction in volume, right? And then there's a flip when 1 or 2, 3 key investors, big funds, institutions are coming in to buy the stock, right? And when you can break down the volume into packets and you figure out when that turn is happening, because these guys, they're so big that they can't just buy the stock in a day. It takes them a month, sometimes 3 weeks. And I was on the other side, so I know how this works, right? It's like a big ship. You can't just turn it on. It takes some time to build a stock into your portfolio. And so, a monopoly or a duopoly, so a champion in the sector, when it's going through a crisis, so it's down 30% or more, we believe that the 1 or 2 reasons why the stock is down is now less worse, so it's getting better. And we see a significant turnaround in the institutional flow into the stock. And those 4 things combined makes up our investment philosophy.
Okay. So, you said a lot of interesting things about volume, about you being on the other side. So when you managed say a couple of $1 billion and you had to open a position, you had to open it over maybe a week or 2, right? Because you couldn't, if you bought all at once, you probably drive the price up significantly and probably not make as much money. Yeah. So, that's how did that work for you? And what is your, track record being in, you talked about picking up monopolies, picking them at the right time, being a crisis investor, monitoring volumes. So how has it worked for you the last 10 odd years, or 12 years you've been doing this?
Thank you for saying 10. Let's stick with 10 because the first 2-3 years of my career were tough. They were really tough because I was a value investor. I was taught value in business school, and I met a lot of mentors who were talking about value. And this was right in the middle of the global financial crisis. Right. So, before I answer that question, just a quick anecdote. I remember one of the first stocks I was looking at and I bought was Yamaha Motor Japan. Okay. And I remember going to my I used to work for this investment guru called Philip Schwartz in New York in ING, who's was very close. I still am very close to him. We chat on a monthly basis. But I said, Phil, we got to buy Yamaha. So, I've taken through my 1-page story, 3 points, right? He goes, what's the valuation, Sundip? So I say, it's 0.75 times book, Phil. It's not going to get worse than this. Yeah. It went to 0.5 times book. Okay. It went to 0.5 times book. So the very harsh lessons that I learned in the first 2-3 years of my career, it wasn't so bad, but just being down 10-12%, and obviously it was a global financial crisis, but still, it eats you up inside. I was always strong on the emotional side of the business, right from the start, but to say that I wasn't hurting is a lie, right? Anyway, so if you leave those 2-3 years out, so the last 10 years, my track record has been about 30% per year. Some years I was up 16-14. Some years I've been up 47-50. Last year in the US, we did a return of 36.5%. So yeah, the track record for the last 10 years has been pretty good. It's been pretty phenomenal, if you ask me.
Okay. Well, that's pretty good. So you have a philosophy, you have a track record. So I would ask you, if I'm down right now, given where we are today, what are some of the things which will make money for me? And then, what do I do as next steps to, turn around my portfolio?
Okay. So, you will see this. You have a lot of people on TV talking about this. You will read this in blogs. Everyone's trying to play this theme where any sector or company that's been hit because of a high crude price, people are saying, hey, you know what? This is now too cheap. Let's go play that. For me, it's a very dangerous trade. And I will tell you why. If you're India, you're saying by 2050, I want to be emission-free, zero emission target. If you're China, you'll say by 2040, I want to be emission-free, zero target, right? If you're anywhere in Europe, you're going to saying by 2030, 2035, depending whether you're Germany or whether you're Portugal, you're saying, I want to be emission-free, right? Everybody has an emission-free target. Guess what happens? If you're then OPEC or Saudi Arabia, you say, okay, in the next 10 years, that's maybe 5 is all I have to juice my assets. You're probably calling up Putin right now saying, thank you. There's no need to take over Ukraine in the next day. We know you're very strong. Take it slow. Let the media badmouth you. Let them laugh at you saying, what, you could not take Ukraine over in 10 days, whatever. Take your time. Why? It keeps the crude price high.
Right.
So, the game theory here is you want crude prices to be as high as you can without rocking the boat too much. So when people say, oh, it's going to 200, possible, but there's no way it stays there for too long. But where it is right now, it can always be at a plus 10, minus 10 this level. So in my opinion, between $105, $110 a barrel to 125 is where it's going to be. So anyone who's trying to play a stock saying it's down too much because crude prices are too high, crude prices will come back as the Russia-Ukraine war ends and we will make a bucket loads of money. That odds, the probability of that is a 50-50. Just for the reason that I just mentioned, I think that is a very tough trade. And along with crude comes in commodities, comes in everything that's related to that, right? So the way I would play it is the Russia-Ukraine theme. So let's talk about, some of these tech companies that actually have a lot of people that they hire from Russia and from Ukraine, if you ask me, Sundip, which stock should you buy? I would tell you about a stock called EPAM Systems, EPAM Systems, which is really a similar company to an Accenture or Infosys in India, but they are very centered towards digital turnarounds. They have digital infrastructure upgrades and stuff like that. Great business. We can talk about that later, but you want to buy themes like that, that will benefit from the war getting done. The war is a phenomenal opportunity every single time it occurs in the history of mankind because it lasts for a month. It creates a certain shock to the system. People panic and they drop the stocks, right? And there is then what emerges as an opportunity, right? So the other space I think this is probably the best bet anyone can take is the technology space. You have a lot of businesses in the tech space, not just tech space when it comes to Google and these big boys or the tier 2 guys, but tech in medicine. And we can talk about this a little more. The medical robotic companies like Intuitive Surgical. There's so many tech companies around the world or in the US that are very cheap today. We haven't seen these kind of valuations since 2003, which was the last tech crisis. So themes like that, themes like tech, themes like what will benefit as this war is completely understood. I'm obviously very sensitive to the pain Ukrainians are going through, but outside of an increased commodity and crude price, I don't think it impacts the investment world too much. Maybe a few sectors for sure, but not overall,
Okay.
And so I think those are much more safer themes to play, especially tech versus, people trying to bet on a crude selling off below $100 and trying to play that theme. I have this friend of mine, he has a lot of money betting that crude will fall to 85. And he's from the industry. This guy, works for Merrill Lynch, is a very smart guy. And he can't give me one good reason. He just says, you know what, I believe in, trading ranges and he's going to come back to the reversion, mean reversion theory. You need to have a lot more logical, fundamental themes behind when you make a bet. You can't just be technical about it. You can't just have volume about it. It's almost like mixed martial arts. That's how investing is. It's too many moving pieces. And the more you know, the more you've mastered, or the more masters you get information from or knowledge from, the better you are. You can't just walk in being a boxer think you're going to win. It just doesn't work that way. So yeah, that's my long story.
Just bet on red and black and hope that one day I'll get, or red and green in the stock market, right? So, so let me ask you a question, right? Like, some of these themes you talked about, like, okay, because of the Russian war, there was a fertilizer theme, or because of this IT company you found which had a lot of
EPAM.
people in Russia, EPAM. So how does how do you find or do all this research and what do you spend a lot of your time on, right? Because if I just think about the investment philosophy, and somebody you mentioned is, okay, you buy good businesses, you buy them when they're 30% down, you buy them when there's a catalyst, you buy them when there's institutional volume, you buy them when there's a turnaround or something else going on. But like, how does like a average investor who has another job, right? Like, like I do consulting all the time, and half the time I'm having dinners with clients, which is not very valuable per se, but it is valuable to build a relationship, right? That's how my consulting world runs. So like, how does someone like me try to keep a tab on all of this, and how much time investment is needed, and how do I get better at this game if I want to? Like, what do you do to like stay on top of this, and how much time do you think is needed to really stay on top of your investments if you want to be as active investor as you?
Okay, so you asked me two questions, right? How do we do it, and what can someone who is in a different profession do to get better at investing, right? we spend a lot of time analyzing companies that we like that are down a lot. We spend almost, today, if you ask me, Shiv, I spend 70% of my time figuring out those one or two key reasons why a stock is down and why they will turn. Because I've been in the industry for long enough I know most of these businesses, right? Very rarely unless it's a new IPO, very rarely will there be a company that I'm interested in that I wouldn't know. By the way, we don't invest in more than 216 as of yesterday companies in the US. And the reason for that is we have a certain checklist. We will not buy companies with poor governance. We will not buy companies where there are issues that we don't understand. If there's a company where I don't understand the way the cash is moving from its P&L to its balance sheet and through its cash flow, I will not buy that, right? So we do almost 75% of my time goes in that. The rest, we do a lot of due diligence and channel checks. So, for example, EPAM, by the way, we made 45% on that trade, right? But I'm not a master in tech. I'm a master in investing. I'm a master in investing, but I unfortunately don't have a knowledge in some of these sectors that I like. For example, chemicals, biotechnology. So what we do is we rely a lot on industry experts, ex-CEOs, ex-CFOs. We talk to them, we channel check people who wholesalers, retailers in that, in their value chain. When we meet managements and CFOs, they tell us what we want to hear. When we are on investor calls, they say what, been in this industry for long enough to know that they sing the song that they want you to hear. They're singing off your playlist.
Right.
So we do a lot of, other kinds of channel checks. So it takes a lot of research, a lot of time. I have a team of now 5 analysts, putting together models for me, and I spend a lot more time, figuring out the turn in terms of, the one or two reasons I was talking about. So if you're an average person who's not in this industry but in any other industry, you would still be a good investor in one or two sectors which you belong to. For example, if you're someone who works in the tech space, right? You work for Google or you work for Amazon, you have way more knowledge than me in the technology space. I will still outdo you in timing, but you definitely know a lot more than me about the industry, right? And so you would definitely be a good investor in that space. But across the board opportunities, for that, you need to spend at least, I'm guessing, 5 to 6 hours on a daily basis reading up on things, or connecting with a lot of experts from the industry. That's a very big time-saving move. For example, if you're interested in fertilizers, for example, for NTR, Nutrient, one of the stocks we bought, obviously, you're from the tech space, so you don't know anything about fertilizers. If you have friends or colleagues or, on LinkedIn, you can find people. Learning that from someone would save a lot of research time. But if, this industry has some of the smartest people, people from best business schools would join the investing side first, then private equity, then venture capital, then investment banking, etc. And consulting, and there's a whole flow, right? So some of the smartest guys, and then there are a whole host of really smart people who are already having 10, 15 years of experience on you, right? So when you're competing with them in the stock market, if you can't at least put in 5 to 6 hours on a daily basis, it's tough. It's tough. So I would urge anybody who's investing on his own to spend a lot of time on just understanding the things I mentioned in my investment philosophy. Yeah.
No, that's very useful.
If you're down 25, sorry, just to finish a shift. If you're down 30%, I would say you need professional help. If you're down 25, 30%, for example, if I have a pain in my tooth and then, I think I need to get a root canal done, I can't do that on my own. I can't see it off YouTube, and get that done. There's an expert in every field, right? And sometimes you need to rely on that. If you're down 25, 30%, what you should perhaps do, and obviously, I also understand a lot of people love this business, right? It's very exciting. It's an intellectual challenge. Maybe what you can do, split your portfolio 50-50. You manage half you give to an expert, and you try and learn from them. By the way, we host. It started with one of the main investors we have is a Chinese family that's based in Singapore, and he used to pester me every quarter to learn about the way we invest and do those things. So what we started to do is we started to do a investor education seminar for our clients every 6 months. So we pass on a lot of a lot more detail on the way we manage money, on the way we invest, and how we manage our risk, things like that. So yeah, if you're down 25-30%, either take out that kind of time, or you split your asset in a way where you are managing half, you outsource half professionally, or make it 60-40 or whatever you're comfortable with. But if you're down 25-30%, sitting on dogs, it's not going to turn around. That's just not the way the world works.
Okay. So I think you talked a bunch about the due diligence you put in, and you try to stay on top for timing as well as information. So you talked about getting professional help. I am assuming you don't mean I go to a psychologist. I mean, I'm assuming you mean like I get like a stock investing advice. So money
management firm.
I know. I'm just joking. So do you provide that service, and how are you different than any someone else who just provides that service?
We do. We have obviously a ton of clients in the US. We have a minimum ticket size of $50,000. We for smaller clients sometimes have trial periods, so they can see how it's going with us for a few months and whatever. The problem in the investment management industry today is that even if a client has had a negative year, investment managers will charge you that maintenance fee of 2%. For me, fundamentally, that is ridiculous. So the first point where we are different is, if we have delivered a year, it hasn't happened yet, but if we have delivered a year where you've made a negative return, we will return the fees to you the following year. Because I don't believe fundamentally that we believe to make money in that year. And my analysts for sure will not, get any bonus in a year like that. So that's the first place where we are different. So, if we have not made you money, we will return the fees the following year, happily with a smile on our face. The second place where we are different is everybody has a profit sharing hurdle rate where they say, if we make you beyond a certain amount of money, then we will charge you 20% of your profits. Unfortunately, in the industry, that hurdle rate ends up, a lot of people don't have a hurdle rate. A lot of funds don't have a hurdle rate. Again, for me, that's Wall Street for you. But most people have it between 7 to 10%. My opinion, so for us, it's 15%. So if we don't make you 15% profit at least, we take nothing from the profit sharing. So those are the two things where we are different. We take pride in putting our money where our mouth is. So again, if we don't make you money, we don't make any money. We haven't made you 15% at least, which is the purpose of being in the stock market. If you're not compounding your wealth at 15% at least in the stock market every year, we would want to do 30. We do 30, but if it's not even 15, there's a problem. So those are the two places where we are different than everybody.
Okay, so to summarize your fee structure, it's like you take 2% fees. So suppose I invested like $100,000 with you, you charge me $2,000, and then if you made me say you made me your average, you made me 30%. So of the 130K, So 15% is your hurdle rate. So 15, 30 minus 15 is 15, and 20% of 15 is 3. So then you would charge me
3% is
3.
what I'll take. Yeah, if I made
Okay.
you 30%, I will take 3%
Okay. Okay.
of the profits. Yeah.
Okay. Okay.
And if I've had a
Okay.
negative year where it's
Yeah.
minus 1%, I will
Yeah.
happily give you back that 2% that I've charged.
Yeah, and nothing on the hurdle rate. Okay. Okay. So that's that's helpful to understand. You're saying the differentiation is that you don't, people will not return, people will not give you the fees back the next year, or they will sometimes even charge you if they don't meet the hurdle rate. Okay, no, that's good to know. So the so we've talked a lot about how to invest, like timing, your philosophy, all of these different things, right? So I think the next two things we want to do is, we want to go into the Q&A session. We want to leave some time for that, but before we do that, let me ask you like a question which, which everyone probably likes to ask you, right? Given all the timing, all the factors, all of that, magical stuff you do behind the scene, what should I buy right now? Like today, like right now, this Monday, if I want to go and buy something, what can I go and buy?
Facebook.
Facebook.
You buy Facebook tomorrow. By the way,
Okay.
we bought it a few days earlier. So
Okay.
I'm
Full disclosure.
yeah, full
Yeah.
disclosure. We bought it 2-3 days ago. If you
Why should I buy
okay,
Facebook?
why?
Is it
Okay,
just
so
a
I'll tell you
fang
why.
down 30%, or then why?
It's down
Like, what?
50%. It's down 50%. I will just tell you
Okay.
2 or 3 things, okay?
Okay.
Why is Facebook down? There's a massive privacy issue. People are saying, you know what? People will not be able to advertise the way they used to, etc., etc., etc. Okay, I think it's very well known. Stock is trading at 16 times earnings. It's never traded at that level. There's one more statistic I want to throw towards everyone who's listening. Every time in the last 10 years, by the way, I bought Facebook in 2013. I was one of the earlier guys to buy Facebook after the IPO, and that's a different story for another time, I'm guessing. But every time Facebook has fallen more than 45% in its last 10-year history, it has made 200% return in the following 2 years. Don't trust me? Check out the charts, do the statistics, run them on your own. Again, I will repeat that. Every time Facebook has fallen 45%, it's happened 3 times. Every time it's fallen 45%, it's given you 200% return in the following 2 years. Why? It's a monopoly. It's a social media monopoly that is not going away anywhere. I want to make 2 more points here. First point, there's a lot of talk about the US government, doing a lot more regulation for tech companies. For someone like me who's lived through active investment management in the global financial crisis, here's what I will tell you guys. When investment banks messed up in 2008, there was a complete furore, right? You had investment banking CEOs sitting in front of senators. They were asking them questions. Oh, we're going to regulate you. And they had all these new, acts coming through where they're going to regulate them. Guess what happened? You know what happened? There was a lot more compliance. There was a lot more paperwork. There was no impact on their profitability. In fact, they made the cost of money so cheap that they were making money by the buckets. Guess what? The tech industry today is a lot more powerful than what investment banking was for America in 2008. The one sector where America still runs the world is technology. They will never impact them profitably. They will never impact their profitability. They might increase their paperwork, they will increase their compliance, but their profitability will not be impacted. I assure you on that, okay? You will still see Mark Zuckerberg coming through a lot more times in front of senators, and they're going to throw tough questions at him. But you might see, countries like Germany levy a fine on them of $500 million, which is nothing for his valuation, but that's going to be the end of it, okay? Now, the reason to buy it is this. Whoever is on Instagram will now see that there are new buttons coming up. If you are a vendor on Instagram, if you're I don't know, you're selling dresses, let's say you're a fashion designer, now there's a view shop button under the person's name where you can actually go and actually transact, right? So you can actually go pick a dress and pay for it around the world. It's not just in America. Around the world on Instagram, you can do that, okay? So what I'm trying to say is that you're going to get a lot of retail sales coming. It's a completely new avenue of business for Instagram, okay? Now, when Instagram went ahead last year and started to advertise Instagram stories, that very quickly became 26% of their ad revenue from zero. It took them 2 years.
Right.
Today, the biggest weapon that Facebook has is something called Reels, REELS on Instagram. Okay,
Like
they
the
don't
TikTok.
advertise on it. They don't advertise on it.
Right.
Anyone who uses Instagram will tell you a reel is a lot more powerful than a story.
Right.
Okay, it's longer, it's more effective from an ad perspective. It can get a lot more hits, etc., etc.
Correct.
They're going to start advertising on Reels very soon, and the moment that happens, it will at least, I mean, at a minimum, you can assume to have the same cash coming in as they had when they launched stories, when they launched advertising on Insta stories. You know what that means? Just that math, just that cash influx over the next 2 years coming in means the stock to be at least 40% higher. Just on that one factor, when they start advertising for Reels. So as an investor, unfortunately, everybody knows the price of companies,
right,
but they don't understand the value of businesses.
Okay.
You know, and so when you invest in a monopoly or a duopoly or, you know, or companies like that, they only get stronger in a crisis. You know, Facebook today has, I think, 89%, if I'm correct, on market share on social media. They could be 100. You know why they're not at 100? Because they're not being allowed to buy. They can buy whoever they want, right? But the competition commission will, you know, clamp down on them. So long answer short, Facebook.
Okay. So
if you want me to give you one more, it'll be EPAM. EPAM systems, you know, we bought and sold it. We made 45%. We sold it. We sold it really well. It's down about 16% in the last 3 or 4 days. We sold it, you know, 5 or 6 days earlier. I'm looking to. I haven't even bought it yet, by the way. But I'm looking to buy EPAM. So, you know, EPAM, a few more days of consolidation, you start to see strong volume coming in. EPAM's a great buy. And I'll talk about EPAM very quickly. EPAM is a smaller version of Accenture. They're brilliant because EPAM has doubled its value as a company every 3 years. So if you're a stockholder in EPAM, you've doubled it every 3 years. Your money's doubled every 3 years, okay? What is the problem? The problem is almost 40% of their people are based in Ukraine and Russia, okay? And guess what? Post-COVID, they have completely improved their work from home, the whole digital infrastructure, etc., etc. This is going to come. They're hiring by the buckets in India, in Brazil, in Latin America. So they're going to turn around that really quick. This stock will at least triple. Triple is the word. Will at least triple in the next 2 years.
Okay. So, and just to be clear, this is not investment advice, right? This is just us talking about stocks and, you know, trying to educate.
This is my individual opinion.
Yeah. Okay. All right. So let's switch on to question and answers. And, people, you can either chat your question or raise a hand, and, you know, you can come here and ask a question. And the first question is from Prathamesh. It's like, what are your thoughts on popular strategies like option trading, IPOs, fractional? I think he's asking multiple questions, but maybe let's start with options trading. What is your thoughts on, like, you know, buying options? Like, you know, do you buy options? Like, what do you normally do, you know, when you invest?
Prathamesh, I don't buy options. I to be very honest, I'm not a big fan of it because you can never bet big money on it. You know, when you're managing, let's say, you know, $1 million of your own money, or even $100,000 of your own money, you can never bet $40,000, $50,000 in options. It's too risky. It's too dangerous. So that is, you know, obviously you can bet $4,000, $5,000, $10,000 and no hope to kill it. But you know, I don't like it too much because you can never take a big bet on it. I understand the payoff is huge, but you know, I feel you can never have a big bet of your capital on it. So I'm not a big fan. Point number 2 is that I don't like the time decay. You know, the best of us can tell you that the stock will rally 30%, but by when will it rally is a very tough one. And the time decay is a problem. Having said that, there are a lot of people who are experts in options and they have made a lot of money on it. I'm not one of
them. I think, and then he has some other questions around IPOs. Like, what do you think about IPOs?
Okay, IPOs can be a great strategy if you don't buy it. Okay, when the IPO lists, it's always at a very expensive price. And you'll always see, not always, 8 out of 10 times, an IPO will list at a very high price. It'll go a little higher for a day or two, and then it'll sell off significantly. In that sell-off, that is the best time to get into some of the good businesses. So IPO is a great opportunity because it adds a lot of volatility, and it adds volatility very quickly after listing, and you can use it to make a lot of money. I love IPOs because people get sucked into it, then they crash out or they cash out, and that creates a sell-off, and that's when we get in. So you have to use an IPO to your benefit.
Okay. No, thanks. So maybe so for other people in the audience, you can ask a question, or if you want to analyze like a particular stock, Sandeep would look at that stock.
Yeah, if you have some stocks in your portfolio that you guys are worried about, you can either message us or you can come online and tell us about it, and I'll be very happy to give an opinion on it if I know about it fundamentally. If I don't know about fundamentally, I can still give you a technical review. I'm good with technicals as well.
So while they think of a question, maybe I'll ask you a question. Like Alibaba, right? Like it's supposed to be one of the good tech stocks, right? And if I'm trying to think, I'm thinking, oh, it's 30% down, 50%. Also, it's so much down. Like it's probably down to where it was like many, many years ago. And and it was like, I think in the 70s or something, it's rallied now to 100, 110. So is Alibaba a good stock to buy right now? Can we look at the chart? Like, what do you think about it?
Alibaba is a great business. I mean, I can see the chart very quickly. I need to share screen for that. Share content. Oh, I'm going to switch you out and become the host.
Yeah, that's fine.
And I'm going to try and share content. Share screen. Start broadcast. 3, 2, 1. Let me just see that chart quickly. Yeah, it has done well. Off late, yeah.
So is it a buy here or buy away?
Yeah. So the Alibaba is a great business. Okay, it's a very well run tech company.
Right.
But there's so many challenges now in terms of just with Jack Ma, what's happening, and how the whole cash is being managed in that company. There were a lot of reports about leakages of some sort where he was trying to manage his cash and move some money out, and there are a lot of unknowns in the company. There's become a governance issue. And I looked at it a few weeks ago, and what's happening at this point is I can share this, I guess, but there are 3 very big sellers at $140. Okay, 3 big institutions who were trapped because of the sudden sell-off that occurred. So they were waiting to sell. So until I see, going back to my initial thought about, how we need to see a turnaround in institutional volume, and we track it very closely. If I know there are 3 big sellers at 140, institutions that I know about, I don't want to share it in the forum, that are looking to sell, I know that cumulatively they have about 2.7% of the company. There's no way the stock crosses that significantly unless you give a buyer or two who can outbid those guys with the same amount of supply, and so for that reason, I'm not a buyer of Baba, because of the governance issues. I wouldn't buy it anyways. But if I'm just giving you my opinion as a trade for you, unless you see big volume cracking open that 140, and if you can call me and ask me, hey, Sandeep, who's buying? And I will tell you how the institutional turn is happening. So just a high volume doesn't do it. It's not about high volume rate, but it's about who's buying. And for that, you need to know institutional brokers. You can call up UBS, Merrill, and ask them, hey guys, you need to have a relationship with them. So once you know who's buying, and if you think that they're big enough to eat up that supply at 140, that is when you can buy.
Okay. So basically, it's not that easy. It is okay. So, but I'm not buying Baba right now. So we have 2 more questions come. One's from Ram and one's from Jesse. So, Ram, do you want to maybe? There's a bunch of questions. Should I just unmute you, and do you want to ask the question directly? Let me see if I can unmute him.
I think his speaker is not working.
His speaker is not working today. Okay, no problem. So his questions are, I think Jesse had a question too. So let's cover Ram's question first, and we can go a little longer. I know, no problem, beyond the one. So he has a few questions. I'll go one by one. First is, what is your take on dividend stocks? Do they provide a good monthly income? And then, his second question is, are SPACs like a dot-com bubble? So maybe we go those first two questions, and then there's some more, then we'll go to them later. Yeah.
Okay, dividend stocks end up doing well when you are in a significant crisis, because then you can be rest assured that there's a 2, 3, 4% dividend yield coming through every year. So even if the stock is down 20, 30, 40%, there's some kind of a income that will come through to you. So there's some neutralization. I have never been a big fan of dividends, even though my investment philosophy honestly is very risk averse, right? Because while I'm trying to hit 30% every year, I still believe I'm risk averse, because I'm not buying anyone who's a number 4 in their field. I'm buying always champions, right? So my odds are much better. But a dividend just doesn't do it, because you just don't make enough returns on companies like that. And it defeats the entire objective of being in the stock market. If all you're making is a 5-6% dividend yield with the risk of losing your capital because of a sell-off or whatever, for me that is just not an attractive enough. Let me rephrase it. There's a better way of making money safely with much lesser risk, or not much lesser risk, but maybe a better risk reward out there in the markets, than to follow the dividend policy. So I'm not a big fan of dividend stocks, because they just don't do enough for me.
And what do you think about SPACs? Like last year, like SPACs was like, the big IPO type thing, right?
Yeah. I'm not a big fan. It's one of those, kind of a get rich quick, situation, which are again very unpredictable. Again, there's so many better ways of making money, in the stock market. There's so many better ways. I understand that, some of these stocks can just balloon, but a lot of people have got trapped in these names, and again, I'm never a fan of the unknown. I like to, I'm a fan where the odds are in my favor, and I take a massive bet on that. And that is really the best way. That's honestly, anybody who's become a billionaire or a multi-millionaire in the stock market has done it through that. A very high conviction, big bet. That is the way to make money in the markets. That's a proven formula across. You take anybody, you take any billionaire from Warren Buffett to George Soros to Stanley Druckenmiller to Paul Tudor Jones. They will all have 7, maximum 8 names that account for more than 60% of the wealth that they've generated through a lifetime. It's 6, 7, 8 bets, and that would not be a SPAC, and that would not be an option, for example, and that would not be, a dividend stock for sure. So if you can take a big bet today on Facebook, or on an EPAM systems, which has a very low probability of falling from here. I don't think my downside is more than 7-8% on Facebook, to be very honest. I might have to wait for maybe a quarter or two. I'm very happy to do that for a 200% return. And I think that's the way to think about the markets. So okay. Yeah, long story short, I'm not a big fan of SPAC either.
Yeah, no, that's helpful. So I think to summarize, you invest when you have higher conviction versus taking, 50% bets, because it's like you said, it's not the number of bets you make in volume, but it's the quality of bets. You make a few high conviction bets, like you gave in your examples. That's the way to make money. Okay, I think his last question from Ram, and maybe we can go to Jesse then, is I think his last question, if I understand is right, he's asking about pharma stocks. Like pharma is like got a lot of random potential, right? Like Moderna went 20x or came back 10x, like whatever. Like like pharma stocks have a lot of volatility. So how do you know pharma stocks have good potential?
Okay. What's happening is, I'm very glad someone brought that up, because I've spent a lot of time understanding pharma, and I have two useless degrees. One is being a chartered accountant, so I understand balance sheets, and I have an MBA. Two useless degrees when it comes to analyzing pharma companies. But I'm good at networking, and I love to tap into knowledge of other people. So I've spoken to a lot of experts on the pharma sector. So here you go. What's happening in the pharma industry globally is that for the first time in a long time, drugs are running or coming off patents. So, pharma really there are two companies. A is the guy who takes the risk, runs all the, different parameters to make the formulations, combines it and sells the drug after getting the FDA approval. Okay. And then there's another set of companies who are called the generic companies, which are coming out of Israel, out of India, out of China. What these guys do is, once the patents run out, they make the cheaper version of the drug and they flood the market. Okay. So believe it or not, you will never make money in one of those formulation guys, the main guys who take the risk. It's just a very difficult game, because a lot of money has to be spent in getting those drug approvals, and a lot of them fail, right? And what happens is, once you've created something like that, the pill is out, the drug is out, people reverse engineer, and they come back with their own versions, cheaper versions of the drug, right? So if you can buy generic pharma companies who are now in the right space, where they are into drugs where the patents have just come off, and they are launching these drugs at 1/10, in some cases 1/15 the price of existing drugs, you will make a lot of money. One of the few companies that I like in the US in pharmaceuticals, I'm not pitching it. It's obviously a great business, but it might not be the time to buy now. Is Pfizer. They're one of the few guys who've done a very good job of making the right investments and getting FDA approvals and managing the entire value chain. But there are all these small cap biotech companies that promise to go to the moon, and you'll see the sudden spike and they fall back. Those are very difficult ones. They're the 50-50 ones. You stay away from those. And those are not predictable by anybody. I used to, when I was at ING, we used to have this Indian guy called, I think his name was Radhakrishnan something, brilliant in biotech. And even he used to tell me, so many of these companies are just a hit and a miss, because sometimes you have to wait for quarters and years for a certain molecule to go through FDA, and you just don't know. There's no predictability to it. You can be really good at it, but still might not know.
Yeah, no, I know one such stock. It was called an SPH. Let's go to Jesse's question. So Jesse, do you want to come on and ask the question? See if you can.
Yeah, I can if you want.
Yeah, go ahead, Jesse. That way you can talk directly with Sundip.
Yeah. Thank you. So Sundip, I was curious. So, like, where should one go for like an education on these topics and investment as a whole? I know there's a lot of like YouTube experts and stuff like that, and that's kind of where I've been kind of learning how to do this stuff. But if you were like looking for like a professional like type of experience in that, like, would you talk about like going to college, or are there like certifications to go after or something?
Yeah. So Jesse, when I went to city school in New York called Baruch College, with these aspirations to join Wall Street, and I very quickly realized that it was a dumb move. My parents couldn't afford to send me to a Columbia, even though I had a 710 on my GMAT, but I couldn't do it because anyways, long story short, you don't get it in a business school. You will not get it on YouTube. You will not get it in any of the forums on the internet. Even if you find that one line that makes a big difference, you will not really catch it, because there are 1,500 expert opinions out there on the internet. And I'll tell you what I did. The way I got into this business, I would cold call mentors. I would cold call fund managers who, some of them were kind enough to spend, 15, 20 minutes with me. And that's all I would ask for. 15, 20 minutes with me on, how do you pick stocks? And I got to tell you, Jesse, if you can network with a fund manager who spent 20, 25 years in the industry, gone through that, learning curve, paid the tuition fee by losing money, tinkering, and then figuring it out. that is more than 2 years at any business school. So what you should do is network with fund managers, give them a call, tell them, hey, you know what? Just want to spend 15 minutes with you. Not trying to hit you for a job. Just want to spend 15 minutes with you understanding how do you pick stocks. And that 15 minutes can be a wealth of information. I was fortunate enough to have, 15, 16 such people in my life. And, they completely took me up a learning curve that I wouldn't have had otherwise.
Awesome.
That's a great question, Doug.
Yeah, no, thank you. I appreciate it. My next question is like, how do you envision like crypto affecting stocks, and like how the division of funds that were traditionally going to stocks, and now there's like this sort of division of funds going into a lot of crypto now. How do you see that affecting the market?
I don't think it'll impact the markets too much. It'll probably be good for crypto. So I view the entire world as a big ball of liquidity, driven by the Federal Reserve, driven by the US Central Bank, obviously, because the dollar is the reserve currency of the world. And when a 1, 2, 3, 4% allocation of that goes to Bitcoin, that impacts the Bitcoin world, but it doesn't impact the equity or the fixed income world because it's just too small. So that liquidity moving to Bitcoin is good for Bitcoin, perhaps, but I don't think it'll impact the equity world at all.
Okay, cool. Thank you. And then my last question is like, given the current conflicts and stuff, how do you feel about like defense stocks like Boeing, General Dynamics, and stuff like that? Like, because if you're betting on war happening, then it's not really a good thing. But it's like as far as like being able to profit off of it, I mean, might as well, right?
Yeah, that's what we saw, right? So on the 24th of February, when we bought NTR, I was looking at RTX. I'll never forget that. I was looking at RTX, Raytheon Technologies, and I was looking at Northrop Grumman, NOC, right? And I wasn't honestly. I was so focused on fertilizers. I was so excited by that I honestly got a little blindsided by not investing in the defense space there. But no, you're right. It's great because they have a very strong lobby, and this is a great time for them to increase the government spending. And I think they're gonna win. They're gonna win some contracts. So while my fertilizer company NTR has done better than any of those names, but I think in the long run those guys will catch up. And the reason for that is you will get constant news about Lockheed Martin winning a deal with the government, or RTX winning a deal with the government, or Northrop winning a deal with the government. And as those news comes, they have a much longer book to bill. Book to bill meaning that you have 3 or 4 years of visible revenue, and you can decide how you want to bill it on an annual basis. So as that news flow happens, you will see defense companies doing well. So any pullback on a good defense company, it's a good time to get in.
Okay, cool. Thank you. I appreciate your time.
Sure.
Hi, this is Nitin Deshpande. Great session, by the way. Thank you very much, guys. I have a question about Google and Amazon. They're both bound to split June first week or second week. When is a good time to buy into those stocks?
Oh, okay. I'm gonna share screen. Okay, so before I go into that, I'm a fan of Google. I'm a fan of Amazon. Great businesses. That business model is not going away anywhere. Every time Google or Amazon falls, then there's always a good time to buy them. Again, I think historically, every time Amazon has fallen more than 25-30%, you've bought it, you've had the patience to ride it, you have made at least 30-40% in the following 12 months. Having said that, let me share screen and give you an opinion in terms of when I think we can buy these companies. Okay. Let's start with Google. Okay. Okay, very similar. Interesting. Okay. Come back. Okay. I would not be a buyer of Google and Amazon only because they haven't fallen enough for me to be excited about it. And I think there are other equally well-run tech companies that can, that have a better risk reward. Having said that, I think if any of these companies fall about 5-6% from here, they don't look like they will, by the way. They might consolidate a little more. I have done work in the past month on how. So basically, what's happened is from Feb 24th, a lot of funds, big funds, are sitting on cash, and so what's happened is they've deployed the cash back. So across the FANG stocks, across credible, good quality tech companies, not Matterport or Upstart or Unity Software, but good quality tech companies, you've seen a lot of money come in, right? So there's been a lot of volume, institutional volume turnaround that I was talking about that we've seen in a lot of these companies. And so there's been a very strong buying. So any 3, 4, 5% dips, what's going to happen is Fidelity will continue to buy, or another fund that has been buying will just continue to buy, right? The way these guys work is the way, we used to work back in the days when we had a much bigger fund, when you are managing a $10 billion fund, you don't put a 1% bet. You take at least a 4-5% bet, right? That's $400-500 million, right? So I'm literally buying over a month. Even if it's a big stock like Amazon, it's going to take me 2 weeks to buy it. So any 3-4-5% drops in both these names, I think you will see buying emerge. So again, any 4-5% drop, I think you can buy it.
Okay, thank you.
But with a slightly longer term time frame. Yeah, so I think you can make about, I would guess, 20-25% in both these names over the next 12 months.
Okay, last year when we saw Tesla after the split, it just had a huge rally. Do you foresee something similar with these two companies?
Okay, no. So Tesla was my biggest bet last year. It was 20% of my portfolio. I bought it in June. I don't know the exact day. I think 16 or 17. I bought it in June. And the reason why Tesla did well was not because of the split. The industry, including the sell-side analysts, investment bankers, they completely got the Tesla earnings revision cycle wrong. And so what we basically had was constant, earnings upgrades happening in Tesla. Credit Suisse, JP Morgan, Merrill Lynch, everyone just had to completely upgrade earnings. And that's what drove the Tesla stock up. It wasn't the split. So I don't think the split will drive the price up for Google, Amazon. Having said that, independently, if their earnings are doing better, the stocks will go higher.
Okay, thank you.
Sure.
Is there anybody else who has questions or stocks they would like to run by Sundip? Okay, we'll give them like 30 seconds, but while they're thinking about it, so Sundip, thank you so much for taking our time from from your investing schedule
Sure.
and providing this talk. So if you've provided a lot of information on how people can do this on their own, but if they wanted to take your help or provide your services, is there like a contact where they could reach you at, and then they could get started on getting maybe recommendations from you or help take your help to manage their money?
Yeah, they can just visit our website, which is www.naganalytics, which ends with the x.com. Where we have our contact details. We have a point person called Cindy. Cindy takes care of a lot of our, client interactions, and her emails on there. So yeah, that's the way. What I could do is, Shiv, or maybe you could do it for me, everybody who's on the call, maybe you can email them our details, and, we'll be very happy to, touch base and share information.
Definitely, I'll email it to everyone on the call, and but this has been super helpful. So and thanks everyone in the audience for joining. And I think we had like a really smart audience. There's some really good questions.
I got some amazing questions. I got some really good questions. Thank you for that.
Yeah. So so thanks everyone again, and again we have some good ideas. Like Sundip said, like Facebook and EPAM and others, and I think we talked about the investment philosophy of trying to get a few good quality calls right. There's a tendency, and I have been guilty of it many times, which I've learned from Sundip, is that I might see something randomly rallying and I want to chase it, and there's maybe I'll win, but it's like roulette, right? It might go the other way. So better make money fewer times with more sure bets than losing and then trying to recover and like just going through like a crazy vicious cycle of
Yeah.
non-quality investing.
Actually, I would like to end with that. The
Yeah.
two reasons, and I was guilty of one of them at the start of my career. There are two reasons why most investors lose money. Number one, they speculate. They don't trade, they don't invest, they speculate. Oh, let's buy Beyond Meat. It just doesn't work there. You need to know so A, speculation, so you should not speculate. And B, if you have speculated and you for any reason, bought a dog of some sort, you need to sell. We all make mistakes. We all buy, we all are guilty of buying crappy companies at some point in our careers. But you need to let those go. It's that tennis ball versus the egg example, right? You drop them both, the egg is going to be on the floor, the tennis ball will bounce back, right? So buy tennis balls. And, if you have an egg, just get rid of it.
Okay, so let's end with that. This is not investment advice. Just buy tennis balls, right? Yeah. All jokes apart, I thank you everyone for joining. I really thank you for taking our time on this.
Thanks everyone.
Bye-bye.
Yes.